Have you ever been browsing, maybe online or something, and you see this really high-quality item, right? A brand you totally respect,
Hmm.
but it's just sitting there with a price tag that makes you do a double take, like
Yeah.
way lower than you'd expect.
Yeah, like finding a designer coat at a thrift store
Yeah,
price.
exactly. Well, imagine that same kind of head scratcher, but it's happening with a massive multi-billion-dollar pharmaceutical giant.
Okay.
So today we're doing a deep dive into Merck & Co. And our mission really is to try and figure out why Wall Street might be getting this company so wrong.
Ah,
The argument we're exploring is that maybe they're just focused on one thing, this patent cliff, and they're missing the bigger picture of this like really diversified, financially solid company that might actually be trading at a, well, pretty good discount.
it is pretty striking, isn't it? I mean, you've got a company with this incredible history, huge impact right now,
Right.
and yet the market sort of sees it as, I don't know, maybe a bit like yesterday's news.
Yeah, exactly.
So that really brings up the core question, I think. What's actually driving that perception of Merck? Why are they being treated like this? And what can we figure out if we look a bit deeper than just the headlines, look at the numbers, the strategy?
Okay, let's do that. Let's unpack it. So, Merck & Co. I mean, these guys aren't new kids on the block or anything. Founded way, way back in 1891.
Wow, yeah, long time.
Seriously, they've really been, you could say, an architect of modern medicine. Just look at their track record. It's it's kind of incredible. Groundbreaking vaccines, antivirals, these truly revolutionary cancer treatments. I mean, it reads like a who's who of medical breakthroughs.
You definitely recognize some of the names.
Oh, yeah.
Yeah.
Keytruda, Gardasil, Januvia.
Correct.
Those are all Merck drugs. Huge impact.
Blockbusters.
Totally. But here's the paradox, right? Despite this amazing legacy, this portfolio of drugs that are leaders right now, Wall Street seems, well, kind of unimpressed.
Yeah, and it's interesting how much of that sentiment seems to circle back to just one drug,
Yeah.
really. Keytruda. Exactly. I mean, this cancer immunotherapy, it's become the absolute backbone of their revenue. We're talking nearly, $30 billion a year?
Wow.
Yeah. And it's approved for, over 20 types of cancer. It's basically the Swiss Army knife of oncology right now. But, and here's a bit Wall Street is obsessed with. There's that patent cliff coming up in 2028. That's the elephant in the room.
Right. The big worry.
The big worry. But here's the counterpoint, or maybe just the fuller picture. Analysts actually think Keytruda could still hit peak sales of $35, maybe even $40 billion before that cliff arrives.
Oh, okay. So it's not like it just falls off a cliff tomorrow.
Not at all. And, if you connect this to the bigger picture, Merck isn't just sitting there waiting for 2028. They're not just twiddling their thumbs.
Right.
They are proactively developing what they call next-gen immunotherapies, combination treatments.
Right.
Basically, stuff designed to keep them dominant in that market after 2028.
So they're planning ahead.
They're absolutely planning ahead. It's like, the analysis we looked at put it, Merck's playing 4D chess while everyone else is just flipping checkerboards.
That's a great way to put it. But, okay, even with those next-gen plans, isn't there still a risk? I mean, Keytruda is huge. Couldn't its decline, even if managed, still drag down revenue for a bit?
That's a fair question. There's always transition risk.
Yeah, and that could spook investors, right? Even if the long game is solid.
It could. Investor confidence is, a fickle thing sometimes.
And like you said, Keytruda is the backbone. But if you thought that was the whole story, think again.
Exactly.
Merck's got a lot more going on. It's a pretty diverse pipeline they're building, isn't it?
Oh, definitely. It's not just about Keytruda. You've got Gardasil, for example.
The HPV vaccine.
Right, which is a massive blockbuster in its own right, protecting against cancers caused by HPV.
Huge public health impact there.
Absolutely. Now, okay, there have been some, let's call them short-term headwinds lately. Some export pauses in China and Japan.
I saw that mentioned.
Yeah, but the analysis strongly suggests the long-term trend for Gardasil is still firmly up. I mean, the basic need for preventing HPV-related cancer, that's not going away.
Makes sense.
And then there's this newer drug, Winrevair, for pulmonary arterial hypertension.
Right, that just launched relatively recently.
Yeah, and it's apparently just blown past revenue expectations already. Over $280 million in its first full quarter.
Wow, okay. That's a strong start.
Very strong. And if you zoom out even further, their whole pipeline. It's just packed with potential. Yes, more oncology, but also cardiovascular, infectious diseases, autoimmune therapies.
So it really sounds like they're building out, not just trying to patch a hole Keytruda might leave.
Precisely. It's diversification. If you thought Keytruda was the end game, well, you need to look again.
Okay, so this brings up a really important question then.
Mm-hmm.
If they have this track record, this deep pipeline, this consistent performance, why is a company this effective being overlooked?
It's kind of ironic, isn't it? The analysis suggests that maybe Merck is so effective, so consistent, that it's actually become boring.
Boring. Compared to what?
Well, compared to, the latest meme stock craze or some super high-risk moonshot gene editing experiment that might pay off big or might totally flop.
Ah, okay. So not enough hype.
Pretty much.
Yeah.
Merck isn't really about hype. It's this disciplined, research-driven company that, actually turns science into sales consistently.
Right.
And that kind of consistency, well, doesn't exactly trend on Reddit, does it?
Probably not.
But it does trend upward on their balance sheets. And that's where the numbers get really interesting.
Okay, let's hear them.
So right now, Merck is trading at around 11 times forward earnings, just 11x.
11. Okay, how does that compare?
Well, think about some other big names.
Yeah.
Biotech peers like Moderna, they're trading north of 20 times earnings.
Double.
Yeah. And Eli Lilly, closer to 50 times earnings.
50. Wow.
Even Johnson & Johnson, another big diversified healthcare company, trades higher than Merck.
So 11x looks really low in that context.
It looks very low. And it seems Wall Street's view is just, well, maybe a bit myopic, focused solely on that Keytruda patent expiration in 2028.
And ignoring everything else.
Pretty much ignoring the massive reinvestment they're making in R&D, this successful spinoff of Organon a while back, and the pretty hefty dividend yield they offer.
Right, the dividend.
In fact, when analysts run intrinsic value models, like, discounted cash flow, they estimate Merck's fair value is probably somewhere between $120 and $130 a share.
Okay, and it's trading around $80 now.
Exactly. Near $80. So that's like a 30, maybe 40% discount to what some sophisticated models suggest it's actually worth.
Wow.
The analysis literally used the analogy. It's like buying filet mignon hamburger prices.
Seeing those numbers, that valuation gap, it really does make you think about that old investing idea, finding the diamonds in the rough.
Mm-hmm.
Is that really what we're potentially seeing here with Merck? Because it's not just looking cheap. The argument is that it's safely cheap. Is that fair?
I think that's a key part of the argument, yeah. Because they also have this fortress balance sheet. And they seem to be making really smart strategic moves with their capital.
Okay, like what?
Well, first off, that dividend you mentioned. It's a healthy 3.8% yield right now.
Pretty good return just for holding it.
Yeah, and it's comfortably covered by their free cash flow. They're not stretching to pay it.
Okay.
And management isn't just sitting on piles of cash either. They're actively giving capital back to shareholders through that dividend and buybacks, but they're also investing in strategic M&A, funding all that R&D we talked about.
And they can afford to do all that.
Apparently, without breaking a sweat, we're talking over $10 billion in annual free cash flow.
$10 million free cash flow.
Yeah. No major debt problems looming, a strong credit rating. The company's enterprise value seems really well supported by its actual earnings.
So the foundation is solid.
Very solid. And here's where it gets really interesting strategically.
Yeah.
Their M&A activity.
Ah, the acquisitions.
Yeah, Merck's been kind of on an M&A masterclass lately. They've been shopping smartly, picking up companies like Prometheus, Harpoon, iBio.
And those deals strengthen specific areas.
Exactly. They specifically bolster their pipeline in oncology and immunology key growth areas.
Smart. Building depth.
And there's even, buzz and speculation about a potential deal for a company called MoonLake.
MoonLake. What do they do?
Dermatology and inflammation.
Yeah.
So that would add another dimension.
Interesting.
The point is, all these acquisitions, they act like another layer of insulation, right? Protection against that eventual Keytruda expiration. It helps build out what looks like a decade-long runway for growth beyond just one drug.
Okay, that makes sense. They're not just defending, they're actively building the future.
That seems to be the strategy, yes.
All right, but let's play devil's advocate for a second. Let's talk risks.
Yeah.
Because no investment is risk-free, right?
Absolutely not, and it's crucial to address them.
So let's tackle them head on. The Keytruda cliff in 2028. We keep coming back to it because Wall Street does.
Right, and it is real. You can't ignore it. But, frankly, big pharma companies know how to handle patent cliffs. This isn't their first rodeo.
We've seen this movie before.
We've seen it many times. Think about Lipitor. Think about Humira. Massive drugs that faced patent expiration. Companies adapt. They diversify. They launch new formulations. They get new indications approved. They use combo regimens like Merck is planning. They find ways to manage the decline and transition. Merck's playbook here is pretty standard for big pharma.
Okay, so manageable, not catastrophic. What about the Gardasil slowdown you mentioned, China and Japan exports?
Yeah, the analysis pegs that as temporary. Vaccine demand tends to be cyclical anyway, and it's often regional.
So those markets will likely come back.
The expectation is yes, China and Japan will be back. The underlying demand hasn't vanished.
Okay. Any other big risks? Tariffs? Geopolitics?
Tariffs are always, annoying for global companies. But again, likely manageable. Merck's already working on localizing more of its supply chain anyway, sort of future-proofing for a world that's maybe a bit less globalized.
Adapting again.
Exactly.
Yeah.
So while they're clearly tackling these operational things, if we step back and connect it all, maybe the biggest risk, the hardest one to fight, is just sentiment.
Market sentiment itself.
Yeah, because sentiment isn't a business model, right?
Yeah.
Fundamentals are.
Good point.
And markets. Well, markets aren't always rational, are they?
Yeah.
They get moody, they fall in love with narratives, sometimes ignore the boring facts, and they definitely chase shiny objects.
It's like the meme stocks or the moonshots you mentioned.
Exactly. It's like they get distracted by the squirrel running across the lawn and completely miss the big, reliable golden retriever sitting right there. Merck, in this view, isn't the shiny object. It's, the analysis called it a damn lighthouse.
A lighthouse. Steady, reliable, guiding.
Right. But it feels like it's being punished for being methodical, for being consistent, while other companies maybe get rewarded more for just hype.
Okay, so wrapping this up then, the core insight from this deep dive seems pretty clear. Merck & Co. is kind of like the adult in the pharma room, wouldn't you say?
That's a good way to put it, yeah.
Not chasing the crazy headlines, just delivering results. Methodically.
Consistently turning science into sales.
And doing it all at a valuation that, frankly, looks pretty compelling, especially compared to its peers.
Right.
You've got the healthy dividend, that fortress balance sheet we talked about, a portfolio still packed with blockbusters, plus the growing pipeline.
And all potentially at a significant discount.
Yeah. So based on everything we've unpacked today, the argument isn't just that Merck is a good investment. The case being made is that it might be a great, perhaps significantly undervalued opportunity right now.
It certainly presents a strong case based on those fundamentals, which leads to maybe a final thought for you, the listener, to consider. Given everything we've discussed today, the fundamentals versus the sentiment, the short-term noise versus the long-term strategy, how often do you really think the market price accurately reflects a company's true fundamental value, especially in the short term?
Good question.
And what might be the real cost over the long run of always chasing those shiny objects, the hype, and potentially overlooking these stable, methodical titans, especially when their numbers seem to be telling such a different, potentially more valuable story?